Hello, welcome to the Stock Out. This is the show at FreightWaves where we set aside a little bit of time to talk about the CPG industry, the consumer packaged goods industry. I'm your host, Mike Baudendistel. I'm the head of intermodal solutions here at FreightWaves. And what we're going to do today on the Stock Out is I'm going to talk a little bit about Instacart. They filed a prospectus on Friday. It's been kind of a lot talked about. I'll think about it from the perspective of the CPG companies. What should they be reading it for? And then we'll be talking to Joe Oliaro, who is the chief real estate officer at Wagner Logistics. They're very heavy into warehousing. So we'll talk and get Joe's perspective on the industry. Before I do those things, I want to make sure if anyone's not already signed up for the Stock Out newsletter, to please go to www.freightwaves.com/the Stock Out, and you can sign up for the Stock Out or point of sale. Point of sale is the retail side of things. The Stock Out is CPG, and we're going to be merging those two things. And so what we're going to be doing going forward is just have one show, one newsletter called the Stock Out, where I'll be teaming up with Grace Sharkey to go through what's happening in both retail and CPG. They're so sort of interrelated. And today's topic is kind of a good case in point. We're going to be talking a little bit about Instacart here. So if you haven't seen it, Instacart filed S1 prospectus on Friday. Maybe that's the first thing to know there is it's Maple Bear is the company's name, doing business as Instacart. And they had a lot of things to say about sort of the CPG industry, but also a number of things on just e-commerce in general, where they said e-commerce for grocery went from 1% in 2009 to 3% in 2019 to 12% in 2022. So the pandemic basically quadrupled the size of the online grocery marketplace. Of course, Instacart has been a big part of that. What they do is they basically facilitate the retailers' abilities to get their products online. So it's not just this Instacart marketplace, but it's also operating under the retailer's own storefronts. So it appears that the retailers have all of the technology in place that maybe they're really just leveraging, Instacart's technology. They bring up some good points how grocery historically has not invested very much in IT, maybe just 1% of their sales. So Instacart could invest more in these processes than the individual retailers could, at least the smaller sort of grocery retailers. We also learned some about the company's business model, where they get about 70% of the revenue from transaction fees, either from working on behalf of the retailer or from consumers, but the other 30% is what they call advertising and other revenue. So primarily advertising does appear to be a higher margin business, and that's really sort of the crux of the business model. I've seen some analysts suggest that that's all the profitability, which is another point here, is that the company was profitable in 2022 for the entirety of the year, and also profitable in the first half of 2023. They also revamped their executive lineup and have executives in there that are really seasoned in the advertising space, have brought companies public, previously. So it does seem like the companies, both with getting their financials to a point of profitability, given that's what most investors want now, no longer growth for growth's sake, and also getting the management team in place that they've been positioning themselves to go public. Mentioned a minute ago that 12% of grocery shopping is now done online. They think that could maybe double. So it does seem like, from a CPG company's perspective, they need to have a strategy to market themselves for e-commerce. And I think the question becomes, is using Instacart the way to go about doing that? They give some suggestions as to maybe, the case that they make is that the CPG companies, when they put their ads on Instacart, can get anywhere from a 15% increase in sales versus what they had on there before to, in some cases, over 30%. They talk about how, they can offer, lots of different ways to do that in terms of advertising, bringing the product up on the page, offering the company's individual product pages, and they have an ability to make it so a customer that wants to buy in bulk can do so. And guess Instacart has the visibility to see whether or not there's enough inventory to make that offer. So they do quite a lot with sort of tracking, making those that advertising sophisticated. So it does seem like an interesting proposition for the CPG companies. They did also talk about how some of the CPG companies are advertising more online. They say that CPG brands spend about $200 billion on advertising, and that equates to anywhere from 20 to 30% of their gross sales. And they say about 25% of that is online. So still 75% of it not online, which suggests that there's really a long way, a lot of runway there, where more of that advertising dollars, can still migrate online, even if that's been the trend. They say they have 5,500 brands that are advertising on Instacart, not necessarily companies. Some of these companies have hundreds or even 1,000 brands, and they mention some of the bigger ones: Campbell's, Nestle, and Pepsi. Pepsi, by the way, investing $175 million as part of a private placement in the offering, and then some of the smaller brands they highlight are Banza, Chloe's Fruit Pops, and Wisps. So let me know if anyone in the CPG industry thinks this is worthwhile or not. Would be love to get your feedback. So that's our one CPG news story today. With that, I want to bring on today's guest. It's Joe Oliaro, Chief Real Estate Officer at Wagner Logistics. Do we have Joe? There's the logo for Wagner Logistics. There you are. Good to see you. Thanks for joining me.
Yeah, thanks, Mike. Thanks for having us on. Excited.
Are you an Instacart user?
I was thinking about it as you were talking about it. I know my wife uses Instacart. I honestly, I don't think I've ever used it. I'm a laggard when it comes to the use of that kind of technology. I'm old school. I don't have a smartwatch, mostly because of my ADD. But no, I don't think I've used Instacart.
Gotcha. Okay. So why don't we start out? Just give us a little bit of an overview of Wagner Logistics for those that aren't familiar.
Yeah. So Wagner Logistics is a third-party logistics firm based in North Kansas City, Missouri. We occupy roughly 7 million square feet across the U.S., across 25 different operations. A lot of what we've done has been steeped in contract warehousing in support of manufacturers, some of which make CPG, consumer packaged goods. We're pretty heavy in the paper industry. We've run with automotive. We do energy. You name it. Since we've been in business since 1946, so you name it, we've probably seen it.
Yeah, so you do a lot with warehousing, a lot with contract warehousing. So what are you seeing in the warehousing market currently? And we've heard so much about shortages. It does seem like the market's maybe correcting. You were on Thomas Wasson's show a few months back, Loaded and Rolling. He said that at the time, warehousing space was about 95% utilized. Where are we now?
So I don't think that's changed a whole lot. The markets continue to be tight. Especially in markets like Dallas, East and West Coast, the vacancy rate continues to be 5% or below. And in some markets, it's much lower than 5%. Good luck finding space in the Inland Empire. When it comes on, it goes right back off the market. So I think really what we're seeing for challenges is storage rates. Storage rates and rental rates for warehouse spaces in these markets where the vacancy is low, it continues to go up. So we're constantly looking for sublease opportunities or to just get in with one of our customers that has a location already and run the locations as a sole operator for them. And that seems to work pretty well for what we're doing. But as the storage rates have continued to increase, it creates a much higher barrier to entry for 3PLs and other groups that are trying to get into that market as a service provider. In addition to that, we're also seeing a drastic reduction in big box warehouse space, mostly
Hmm.
because some of the developers around the country, like Prologis, North Point Development, they've cut their pipelines in half for these large, big box warehouse distribution centers, mostly because of interest rates, construction lead
Hmm.
times are up, and
Hmm.
then also, construction materials are way more expensive than they were a couple of years ago. And so I think they're not completely shutting off their pipeline, but they are drastically reducing it to kind of wait out the storm.
Yeah, that's so interesting because we went through this period of such extreme tightness in warehousing space. And then the narrative started to shift where we're going to be a lot of building and we're just going to overbuild it. We're going to just overshoot the problem. But then I don't think anyone anticipated the interest rates to be up so quickly in such a short period of time. And it's hard to adjust to that. I mean, in some of these low vacancy rates for the warehousing, do you get a sense of it being temporary because the consumer is still under a lot of pressure, or do you think that shortage is going to be with us for some time? I mean, some of the carriers like JB Hunt the other day at an investor conference said that some of their customers say things are fine, inventories are right size, but others say it's kind of still elevated, kind of mixed. What are you seeing?
So we see both of that as well. So we see a wait and see mentality from some of our customers and folks we're trying to do business with, um, and in a post-COVID um, world, consumer behavior is continuing to shift, and so
Mhm.
it's we've seen a lot of CPG groups that are having difficulty understanding where the consumer demand is going. I mean, you were talking about Instacart earlier. If you look at a few of the top trending product items that are out there, you're talking lip stain,
Mhm.
matcha, which is powdered green tea, and
Mhm.
what was it? Power tool accessories were the like top three trending items for CPG items that are being sold online. So trying to disseminate some of those items into a larger mass scale demand, very difficult. So the
Mhm.
pricing strategy that the CPG groups are using, um, it doesn't line up with what people are doing. And if they're just spending their money on what I would call items that don't keep the lights on at the house or don't keep people fed,
Mhm.
it's hard to forecast against that.
Yeah, a lot of conflicting data points for sure. I mean, it's like for all you hear about sort of trading down, it's still a lot of big CPG companies say their elasticities are low and people are still spending. It seems like maybe these people are on different tracks. The manufacturers that you talk to, you hear a lot about companies trying to build resiliency into their supply chains. You hear others say, well, maybe you just want to have it streamlined, have sort of one centralized warehouse. How do you sort of think about balancing those two things?
I think if you're a shipper and you want to have multiple providers, the best way to do that is to divide them into channels where they're the best fit. Um, and so we're seeing partnerships where you know depending on how many product channels you have and what the requirements are across that particular supply chain, you might find a provider that excels in that particular product type, whether that's a charcoal or a kitty litter or large roll stock paper. There's all kinds of different means of handling those kinds of products and those touch items that require a different level of expertise. So finding a partner or multiple partners that can handle things in different ways
Mhm.
seem to be, at least for the larger CPG groups, that's typically how they handle that end.
Yeah, that makes a lot of sense. also wanted to ask you about your use of automation in the warehousing, and if production can bring it up. We do have a video clip that shows robotics in your warehousing. This was one that you guys sent to me, and so I think
Oh yeah.
so. Can you talk about a little bit what we're seeing here? So you have robots going to shelves, and you have another robot taking it to a different step in the warehouse, and then I guess the idea is ultimately this is going to drive tremendous amount of efficiency and maybe just having the picking be correct, or what can you tell us about this operation here? It looks like something out of a science fiction movie. All these robots walking in time.
Yeah, so this was a small item fulfillment center that we built out in our main facility in North Kansas City. And the impetus behind this was we had a customer that was projecting high volumes of activity. And we pitched them the idea of, okay, well, let's put in some automation here that will ramp up the number of picks that we can make. And so you have these robots that are cycling through what we call a library of different SKUs. So each of the boxes on the right there represents a different SKU. The robots would go and grab the SKU as a part of an order that come across, and then you'll see the robot also dropping it off on a wall here in just a second, and that's the pick wall. And so the other side of that pick wall is so right now it's showing the replenishment wall, and then this is here where it's dropping it off is the pick wall where the product is left there, and then a picker on the other side of the wall all they have to do is go back and forth. So it drastically increases the amount of picks that you can make, the orders you can process. And we designed this specific library and fulfillment center in order to be scalable. So it took up a fairly small footprint. Scalable, I guess, also refers to the cost. We picked up those shelves from Home Depot. It was something that didn't require a supreme amount of infrastructure like an Amazon facility would. This was something that we could pack up and put away, or scale up to 100,000 square feet if we needed to, and that allowed us to do it quickly and efficiently for the customer, and get the orders out the door as needed.
Yeah, it seems huge for efficiency. We want to ask you, you looked at your website and it said that you had 24 warehouses, I think, in 22 different cities. How do you go about selecting the site within those cities?
So it's kind of twofold. So in many cases, our customers come to us, our existing customers come to us and they say, hey, we want to be in Dallas. We want to be in Jacksonville, Florida. We want to be in this particular market. And they know where they want to go. In other cases, they will come to us and they'll say, where should we go? And we have an idea of where some of the best places based on their needs and their network, of where we can suggest for them to go. And then we also like to build, and as a part of that, we've started targeting some of those markets as a campus style facility where we might have a dedicated operation in one part of town and then a multi-client warehouse in another portion of that particular metro area. And that campus style that campus of facilities allows us to leverage labor across the two facilities or multiple facilities, cross-train across different product types and ways of operating and handling equipment and product, and gives us a distinct advantage when we go in to get more business in that market. We'll likely have some available space that we can dedicate to that and provide more value to current and prospective customers. And that's really how we go into, considering a market. Is how many customers can we service in that market, and what's our ideal footprint?
Yeah, it makes a lot of sense. And then can you, let's say with CPG companies, consolidate, let's say LTLs into truckload? I mean, we hear some of CPG companies trying to do that, where let's say there's a shared warehouse across a number of different shippers. They're trying to move a truckload, let's say, to a Walmart or Target distribution center. Did you do a lot of that, the consolidation of LTL into truckload?
Well, we've looked into doing more consolidation. The challenges come into negotiating all the tariffs and the infrastructure required to handle a large amount of LTL activity. It's a major barrier for mid size to smaller 3PLs. It can be pretty expensive pretty fast and require a lot of attention to be able to handle that level of consolidation, especially if you've got, an Instacart that has 1,000 different customers that are servicing one retailer, or, trying to understand how all those moving pieces come together can get pretty complicated pretty quickly. So for mid-sized 3PLs and smaller, it gets expensive and resource and non-resource friendly as it gets more complicated like that.
Mm-hmm. Yeah, you mentioned a minute ago labor and how you're sharing labor across different facilities within a metro area. How are you finding the labor market right now?
Uh, it's been a challenge for the last few years, and it's honestly, it's always been a challenge. The expectations of the customers, the expectations of employees themselves, continues to evolve, and we've had to get creative to handle that. So I think we spend roughly $1,000 per employee just to recruit that employee, and that's whether or not we hire them. So a lot of time and resources and effort goes into hiring and recruiting employees. From a temporary employee standpoint, we've had to get creative, and we've partnered with a group called Variable here in Kansas City, and it leverages the gig economy. So if you wanted to drive a forklift on a Thursday for maybe 3 or 4 hours, you could get on Variable and sign up to work at our warehouse. And we've instituted an expedited training program that allows us to vet that individual and make sure that they are who they say they are, and get them in the warehouse working. And the intent there is to replace roughly 10% of the workforce, but it also gives us more flexibility and elasticity when we need temporary workers. What we've found is that those temporary workers coming from a variable or from a gig perspective are much more excited and more eager to be more hands-on in the warehouse. They're there because they like what they're doing, and it's not. I guess it's not like a hobby for them, that they're making money doing it, but it's a different kind of conversation in that regard, which has been kind of refreshing. And so taking those creative approaches has been beneficial so far.
Yeah, that's interesting. It is creative. And it's interesting to hear your perspective that those have been good. Those have been good workers. Any other ways that, let's say, a CPG company can avoid on time and in full fees? That seems to be on everyone's mind. Especially now that the retailers are pushing for convenience and orders that are perfect and all of those things.
Yeah, so OTIF, or on time in full, kind of came in to replace the case fill rate as a metric in CPG warehouses. And we see about 25% of orders or trucks arriving early to fulfill the orders. And I think what we've seen and what we've gleaned from some of our customers is that having a channel focused partner that understands how to process those orders, how to get them in the door, and is important. But I think one thing to keep in mind is that OTIF is still not really standardized yet, so it's hard to you need to be on that level of communication on, who's going to deliver or who defines the date requested. Is that the retailer? Is that the manufacturer? Who defines the delivery slot of, what is that definition? And and then what does in full mean? And so until that becomes standardized, you just have to stay in close communication with all the different groups there and have clear definition between the two parties of what on time in full means to those groups.
Yeah, really good point there. You do wonder if it is going to be standardized, or if some retailers are always going to push it, forward and be more demanding. But that was great. That's really all the time we have. But how can people reach out to you and find more about Wagner Logistics?
Yeah, you can find us at wagnerlogistics.com. You can find us on LinkedIn, and you can find me on the socials on LinkedIn. But yeah, we're here in Kansas City. We're all over the country, and we're not going anywhere anytime soon. So
Sounds
thanks
great.
for having us.
Thanks very much. Absolutely.
Yeah, thank you.